We have a sovereign debt alarm going off in the UK. Hold on to your hats, folks. The UK bond market is taking us for a wild ride, and it's time we talk about this. Just want to take a quick minute, share some thoughts in reference to what's happening in the UK. I think the debt market there is definitely an indication as to what we can expect around the world as we get further into the summer as well as the rest of the year. And there's a lot of tremors happening right now that's definitely worth bringing to the forefront. So if you guys want to see more short takes like this, definitely hit the thumbs up button. Show your support for the channel. Definitely share this so more people can find out what's really going on. Trying to get this out in real time as best I can. And also make sure you guys comment down below. Let me know what you're thinking. We'd definitely love to get more of a dialogue going back and forth in the comments section. So what's going on? The ground beneath the UK government bonds is starting to shake. We're witnessing a plummet in their levels reminiscent of the tremors of the global financial crisis. Alarmingly, this free fall is fueled by the market's increased belief that the Bank of England will continue hiking interest rates well into the next year to try to fight inflation, as they're saying. Yet the market's betting table shows odds pointing towards a 6% interest rate hike by February. To put this into context, such monetary tightening was last seen in the aftermath of the ex-Prime Minister Liz Truss' controversial spending plan. We all know how that ended. This unsettling forecast has its roots in the recent surge in wages and an unanticipated drop in the unemployment. But that's not all. The yield on the 2-year note has taken a giant leap, reaching a staggering 4.89%, the highest since the infamous 2008 financial crisis. Even as the pound gains strength against its group of 10 peers, this massive jump is definitely sounding a lot of alarms. Adding fuel to this fire are the recent comments by the Bank of England's newest rate setter, Megan Green. Her warning about the lurking danger of persistent inflation and the uphill battle getting back to the 2% target sets the tone for the market's response to the gilts. According to Imogen Batra, head of the UK rate strategy at NatWest Markets, he's quoted as saying, "Demand for gilts won't return meaningfully until investors are confident that inflation is on a sufficiently downward trajectory. With data surpassing us on the upside, the revival of demand seems to be an elusive dream." The UK bond market has been trailing behind other major developed economies this year, despite the Bank of England's attempts at tightening over the 4 percentage points since late 2021. Inflation is showing no signs of cooling off whatsoever. The central bank's decision to sell bonds from its quantitative easing era holdings, coupled with the government flooding the market with gilts to fund its budget, only complicates the situation even further. So what does this mean for the future? The inverted UK yield curve suggests a growing concern about the growth outlook and indicates that the market expects rates to fall well into the future. At the end of the day, the current state of the UK bond market demands caution. It's clear that they're navigating through tough times right now, and the market distress is evident. And while some investors believe the sell-off is nearing an end, you can't ignore the signs of this turbulence. And these are the type of tremors I've been talking about for quite some time now that just shows that the sovereign debt crisis, they're not isolated events. It might be in the UK today, somewhere in the Euro tomorrow, but eventually it's going to make its way here to the US. So there's a lot that we can learn from paying attention to events as they unfold in the UK, because the debt market ultimately tells it all. So only so long you can keep a Ponzi going before things start to be exposed as unsustainable and irresponsible fiscal and monetary events. But remember, it's better to be safe than sorry. So fasten your seatbelts. It's going to be a bumpy ride in the global markets. And so this is definitely something worth paying attention to. Curious to hear what you think. Share your thoughts in the comment section. If you found any value, hit that thumbs up and I'll see you later.